the big risk they're running is that we face a new Cold War. And in the case of the new Cold War, what is to my mind certain is that the priorities of Western investors and their legal rights will be extremely low.
Welcome to another Breakout with Breakingviews, brought to you by PGIM. I'm Rob Cox, coming to you from Zurich, Switzerland. Well, investors had a rude shock last month when Beijing abruptly changed the rules for Chinese education companies listed in the United States. Eddie, you've written about this issue. We've seen it in New York with companies that are listed there from China, but it goes bigger than that. Why don't we just focus, though, quickly, what's happening with U.S. listed companies?
So what happened is that the Chinese companies listed in the US were listed with a very complex arrangement, offshore arrangement, which basically gave the US investors a claim on the cash flow of the companies via this offshore entity, but no actual claim on the assets. And this arrangement was sort of, if you will, quasi-legal. It had never been endorsed by Beijing and never been slapped down. And then suddenly Beijing changed the rules for education shareholders, and they found that they had no claim on the assets. So the educational shares fell to zero or near zero, and the rest of the market came down 50% off its peak of the US listed Chinese companies. And my thought is that the investors in these US listed companies hadn't thought much about the sort of their legal position. They just hadn't bothered to read the small print. And I think that the big lesson is that actually investors in mainland China are not thinking enough about the jurisdictional risk that they face when they put their money in the mainland.
So this issue of variable interest entities, which are basically Chinese companies listed in the US, is a warning sign about investors who also have assets, or they think they have claim to assets on the mainland of China, which is a much bigger pool of money.
Yes, and the simplest way to think of it is this: is that when you own a share in a company in the West, it is governed by established contract law. But our rights to property are governed by the rule of law. In China, the rule of law has never been firmly established. Instead, we have what's known as the rule by law. And what the rule by law means, in the end, whatever the central government decides goes. And in other words, the central government will decide how to allocate capital, and the central government will decide in the end who receives profits and where losses fall. And the Western investors, unless they understand this game, are likely to make the same mistakes as they made with the US listed companies.
Right. So basically, the government in Beijing can decide what it likes, can do what it likes. So this example of basically saying, we don't want people to make profit from education, and like that vanishes these productive assets that people invest.
Yes. So in China, companies, but state-owned companies and many private companies have a party committee on their board. And the party committee, in effect, the company has to make its strategy conform to what the party committee and the policy of the state. And you saw last year when Jack Ma of Alibaba sort of got too big, tried to float Ant Financial, and said rather arrogantly that the Chinese state-controlled banks were like pawnbrokers. Then then he received the wrath of Beijing. And I think that really is a risk that can happen to in effect any mainland listed Chinese companies. You never quite know what you have. Now, of course, that's true to some extent. You have regulatory risk in the West, but the risk of sort of state seizure of assets is much greater in China.
And is there a history of this in the corporate or sort of equity space or in the debt space that would give you some indication how that would go down?
Yes, I mean, you had a few years back, you had companies that were taking money out of China, investing abroad, Angbang Insurance and HMA. Those companies sort of fell foul of Beijing, and pretty soon both were put into bankruptcy, and the head of one of those companies died under mysterious circumstances.
Right. Now, from a debt perspective, I mean, where's the biggest risk? Is it a debt perspective, like the amount of debt that is held by foreigners that could be at risk? Is it equity? And how big a deal is this? I mean, are foreign fund flows still going into China in such a degree that there would be some great concern, systemic?
Well, there's been a rapid increase in the flow of Western capital into China since they opened both the equity markets and the bond markets to Western investors roughly 5-6 years ago. And the amount of money of Western portfolio capital invested in the mainland has risen roughly fivefold to the end of last year. At the moment, the Western investors, so the equity investors, they're looking for an asset that they believe is uncorrelated to and add some diversification. The fixed income investors are looking at 200 basis points above the 10-year treasury on Chinese government debt. So they're attracted by this by the yield increment. And those flows, and this is quite interesting, those flows are increasing this year, despite the Alibaba stories, despite the VIE stories. And the question really investors have to think about is what risks exactly are they taking?
But I mean, up to now, the Chinese listed companies or Chinese stocks have underperformed, say, the S&P 500 now.
Yeah, that's true. And I think that's because the allocation of capital, is not efficient in China, and companies are not in aggregate profit maximizing. I think the biggest problem for investors going forward is, as we're all aware, we have this sort of slow motion deglobalization going on. And it started with the Trump tariff wars, and it's continued with, the sensitive technology, the battle, the war against Huawei, so to speak. And then you have this problem with the sort of the question of the origins of COVID-19 and China slapping tariffs on Australia, which was one of its largest largest importers, trade partners with raw materials, and when the Australians asked for an international investigation into the origins of COVID, Beijing then slapped these tariffs. So the question is, it may be that this deglobalization doesn't have, it just stops where it is and things go back to normal. In which case, investors in Chinese equities and bonds, they may do all right. But the big risk they're running is that we face a new Cold War. And in the case of the new Cold War, what is, to my mind, certain is that the priorities of Western investors and their legal rights will be extremely low. Another thing to bear in mind is that China has had this, as you know, has had this enormous credit boom over the last 12 years, since 2008, one of the great credit booms of all time. And I think, I've been saying, sooner or later, there will be a day of reckoning for this credit boom. And at that point, Chinese government will have to decide who gets paid and who doesn't get paid. My bet is that when that happens, the foreign portfolio investors are going to be very low on the list of recipients.
You don't think hedge fund managers will be anywhere higher than, say, normal Chinese citizens?
I think they'll be at the bottom.
All right. Well, thank you, Eddie. Another interesting column, and we'll be back with another breakout from Breakingviews soon.
Thanks, Rob.